So we'll go ahead and get started with problem 9-1B. And as always, I'm working the problem set B related to the problem set A that I have assigned for you. So we will work through 9-1B. You'll be assigned 9-1A. You've probably already figured this pattern out, but that's the way we've been going through the assignments. So on page 425, problem set B, problem 9-1B, we have several transactions, and the first thing they've asked us to do is to determine the maturity date for each of the three notes described above. And so just to kind of get some pattern going here so we can follow along, we'll look at the date of the note, term of the note in days, and then the maturity date, which is what we're trying to figure out. Now, a note means that if it's a payable, it means that you have borrowed money from someone, or you owe someone money for some other reason. Maybe it was merchandise or services, but there's an official or formal promissory note that's been drawn up that says you owe this money by this date and we're charging you this much interest. And so this company has a note with Fox Products, it has a note with Spring Bank, and it has a note with Citibank. And we're given the information in the problem, and so we can go back and look at the information that we're given. And so for the first one, we purchased $5,000 of merchandise on credit from Fox Products. Terms are 110 net 30. They use the perpetual inventory system. On May 23rd, we replaced that accounts payable with a 60-day $4,600 note bearing 15% annual interest along with paying $400 in cash. And so that note, the date of that note was May 23rd. You wouldn't go back to the note, the accounts receivable. You go to actually when the note was drawn up for 60 days, and that would make the maturity date on that note July 22nd. For Spring Bank, we borrowed $12,000 cash by signing a 120-day, 10% interest-bearing note with a face value of $12,000. So that happened on July 15th. It was 120 days, and so the maturity date on that would be November 12th. And this is just simply calendar dates. There's nothing magic about what we're doing. It's just simply going off of a calendar. And then Citibank, we borrowed $8,000 cash from Citibank by signing a 45-day, 9% interest-bearing note. So this happened on December 6th. It was 90 days, and so the maturity date on that would be January 20th. I'm sorry, 45 days. I knew that didn't add up. Okay, so that's the first part of notes. And if you've noticed now, there's an amount, there's an interest rate, and there's a term, or how many days. It can be years, but these are small because we're looking at current liabilities. The next thing they ask us to do is to determine the interest due at maturity for each of the three notes. And so now we're looking at the interest due at maturity. And remember, when we're given an interest rate, we assume annual. And so all of those interest rates we were given, you always assume that they're annual. So you have to do a fraction of the year in order to determine how much interest we pay, because if it's only 60 days, you don't have to pay a full year's worth of interest. You only have to pay 1/6, or 60 over 360. So the principal on the note, in other words, the face value, how much you borrowed, the interest rate, the fraction, this one's 60 over 360, and we use 360 days in the year for consistency and to keep things simple. That's standard practice. And so the interest expense would be and I'm going to have to, I want you to see that, but I have to convert it so that it will calculate correctly. But you saw what I did there, 60 over 360. So the interest expense for that note is $115. This one is $12,000. That's the face value. It was 10% interest, and this one is 120 over 360 days. This one was $8,000 with 9% interest, and it was $45 over 360 days. And let's do some formatting here. Typically on fractions you would only see maybe 4 decimal places, and then as you've seen before, we can just fill this across to calculate the interest. Okay, so the main thing there is to note the fraction of the year and to understand this is annual, so you have to annualize the interest rate. Okay, the next one, it asks us to do the accrued interest on Citibank note at the end of 2014. So as you hopefully have picked up, when we issue financial statements at the end of a period, we have to accrue any expenses that we haven't paid but that we have incurred. And so because interest has incurred throughout the year, even though we haven't paid it, we have to show that on our financial statements. And so on the Citibank note, we have to look back and we see that that was issued on December 6th. And so we have to figure out how many days was that interest in 2014. So there's a couple of different ways you can do this. I'm going to do it the way the book does, just so as you read through, I haven't gotten used to the F2 on the Mac. You have to hit the function key, and I haven't gotten used to that yet. But we could look at it this way. This probably isn't the way I would do it. I would get the same amount, but I probably wouldn't go about it this way. But I want to be consistent with your book, and this makes perfect sense doing it this way. So what I would do, what they've done here is they've said, okay, what's the total interest? Well, the interest is $90. What fraction of the term happened in 2014? So this would be from December 6th through December 31st, or 25 days of the 45 days. It's a 45-day note. And then we would just simply multiply that times that. And we know that $50 is accrued. And the journal entry, it doesn't ask you to do the journal entry, but if you did the journal entry, you would say interest expense, and the credit would be interest payable. And that would be for the $50. And so what you've done now is you've showed on your financial statements through this expense that we have incurred this much interest even though we haven't paid it. Again, trying to convey to the readers of our financial statements what's actually going on. And then in number 4, it asks us to determine the interest expense to be recorded in 2015 on that same note. And I'm going to go ahead and remove this because we'll actually do those later. And I don't want to confuse you by doing it twice. And so I'll go ahead and take that off. But in 2015, how much? Well, if we accrued 90 in 2014, then in 2015, it would simply be $40. So again, just kind of an understanding of what we're doing here. And then finally, in number 5, it asks us to do the journal entries for all of these, and that's quite a bit. So we'll go ahead and do them all for review. On April 22nd, you acquired inventory of $5,000, and you didn't pay for that. You owe for that, so $5,000 there. And we'll do a little formatting just so we can. And then basically, these are very similar to you. We've already seen this entry, but let's look at this one on May 23rd. We changed that accounts payable that we originally owed. We changed that to a notes payable and cash. And I'll go ahead and add Fox on there so we don't forget. Now, if you remember on this one, they had to pay $400 cash, and then they signed a note for $4,600. Okay, and then on July 15th, very similar transaction, cash. They borrowed $12,000 cash from the bank, and now they have a notes payable to Citibank for $12,000. And then, I'm sorry, that one was Springbank. Citibank comes up later. And then on the 22nd, we had the note come due to Fox, and so we paid that. We had interest expense, which we calculated earlier. We debit the notes payable for Fox so that we can decrease that so that it no longer shows up on the books. And then cash went out to pay off that note of $4,715. Then on November 12th, the note came due on Springbank, and we know the interest expense on that was $400, and so we debit notes payable so that that is no longer showing up as a liability, and then cash went out of $12,400. Next thing that happened on December 6th, we borrowed $8,000 cash. This one was from Citibank. $8,000. And then on December 31st, if you remember, we accrued, that was the journal entry I did earlier. We accrued that interest expense. In other words, we don't have to pay it at the end of the year, but we do have to show the readers of the financial statements that we owe that money and that we have incurred that expense. And then on January 20th, when this comes due, watch this one closely, the interest expense is only going to be for what we expensed in 2015 because we've already expensed the $50. But we are going to pay that $50, and so we remove that or debit that on our general ledger so that we can zero out that account. Notes payable, again, we no longer owe that, and the cash that goes out is $8,090. And I believe that wraps up problem 1B. And so on our next video, we'll be looking at problem 3B.